Today we are going to the source. We are looking at the book,
The Heavyweight Champion.
the absolute heavyweight champion of the financial world. If you've ever bought a stock or even just thought about your 401k and be honest here, if you've ever laid awake at night wondering why some people seem to get rich in the market while others lose their shirts, this is the deep dive you've been waiting for. We are tackling The Intelligent Investor by Benjamin Graham.
It's great to be here, and you're right to pause on the magnitude of this one. We aren't just summarizing a how-to guide on getting rich quick. This isn't, some trendy book about crypto.
No, not at all.
This book is widely considered the cornerstone of investment literature. I mean, it is the definitive text on value investing.
I was looking at the background notes here, and the numbers are just wild. It sold over 1 million copies. But in the world of books, plenty of things sell 1 million copies. Cookbooks, thrillers, celebrity memoirs. This feels different.
It's very different.
It's not just about the copies in print, is it? It's about the legacy.
Exactly. It's about who read those copies and what they did with them. Benjamin Graham isn't just an author. He's celebrated as the, quote, greatest investment advisor of the 20th century. But what really proves his method works isn't just the text itself, it's the people he taught.
The disciples.
The disciples. He didn't just write a philosophy, he created a lineage. The source material highlights names like Irving Kahn, Mario Gabelli, Howard Marks.
And these aren't just random guys on Wall Street, right?
These are titans. These are people who built entire careers, massive fortunes, and managed billions of dollars based on the foundation Graham laid out. They essentially took this book and proved it works in the real world over decades through booms and busts.
And that is our mission today. We want to decode this philosophy. We want to understand why this book, written decades ago, is still the gold standard. But I have to play devil's advocate for a second.
Please, go ahead.
I think when most people hear classic finance book from the mid-20th century, they immediately check out. They think, okay, this is going to be dry. It's going to be charts. It's going to be PE ratios and balance sheets. It feels intimidating or boring, or maybe just irrelevant to the digital age we live in.
It certainly can be perceived that way. And look, finance can be dry. There's no getting around some of that.
So is that what we're doing? Are we going to spend the next 40 minutes crunching numbers and looking at spreadsheets?
Not at all. And that is the biggest misconception about Graham. While the numbers matter, of course they do, our deep dive today is going to focus on the human element that Graham emphasizes over and over again. We're talking about discipline, we're talking about psychology, we're talking about safety.
So it's less about math and more about how you think.
Precisely. The numbers are just tools. The real challenge, and what Graham mastered, is the mindset, the emotional control. The ability to stand apart from the crowd when everything in your body is telling you to run with them.
Okay, I like that. So here's the promise for you, the listener. By the end of this deep dive, you're going to understand the massive fundamental difference between gambling with your money and actually investing it. And maybe most importantly, you'll learn how to sleep soundly even when the market is going absolutely crazy.
That peace of mind is probably the most valuable return on investment you can get.
Let's jump into section 1. We have to start with the core philosophy. If you open chapter 1, Graham doesn't waste any time. What is the first thing he hits you with?
He draws a line in the sand, a very distinct hard line between two things that most people, they think they're the same thing, the investor and the speculator.
I feel like these terms get used interchangeably all the time in the news. You hear speculators drove the price up, or investors are worried about the Fed. It sounds like just semantics, like saying movie versus film.
In common conversation, sure. But for Graham, the distinction is life or death for your portfolio. It's everything. He gives us a very specific definition. It's almost like a checklist. According to Graham, an investment operation is one which meets 3 specific criteria.
Okay.
1, thorough analysis. 2, safety of principle. And 3, adequate return.
Okay, that is dense. That sounds like a legal definition from a textbook. We need to unpack that, because if you miss one of these, you aren't investing. Let's take them one by one. What does he mean by thorough analysis?
This is the big one. Thorough analysis means you are not buying something because your neighbor mentioned it at a barbecue. You are not buying because you saw a ticker symbol trending on social media.
So gut feeling doesn't count as analysis. I like the CEO. He seems cool.
It's not analysis. Definitely not. And neither is looking at a chart and saying, oh, it's going up, I better get in. That's momentum, not analysis. Analysis means you are digging into the business. You're looking at the financial health, the balance sheet, the income statement. You're understanding what the company actually does and how it makes money.
You're doing the homework.
You are doing the homework. You are treating a stock not as a piece of paper or a lottery ticket, but as a part ownership in a real business.
It's the difference between betting on a horse because you like its name and betting on a horse because you've studied its pedigree, the track conditions, and the jockey's history.
That's a fair analogy. But Graham would probably say if you're doing it right, it shouldn't feel like betting at all. Which leads us to the second point, safety of principal.
Principal being the money you started with, your seed corn.
Right. The money you put in. This is a huge shift in mindset for most people. Think about when you open a brokerage app. What is the first thing you think about?
Usually. How much can I make? Is this going to double? When do I get my Lambo?
Exactly. You are focused on the upside, all the glorious potential. Graham flips that completely on its head. He asks, how do I make sure I don't lose? The primary goal isn't to make $1 million overnight. It is to ensure that the capital you put in is safe from permanent loss.
That sounds, I don't know, conservative? Almost pessimistic.
It's prudent. Remember, the math of a loss is brutal. It's just unforgiving. If you lose 50% of your money, you have to make 100% returns just to get back to where you started.
100%, wow.
If you lose 90%, you need 900%. Safety of principal is the engine that keeps you in the game. If you lose your chips, you can't play the next hand. It's that simple.
Okay, so we've done the homework with the analysis. We've protected our downside with safety of principal. The third part is adequate return.
And notice the word choice there. He doesn't say spectacular return. He doesn't say mind-blowing gains.
Or 10x your money.
No, he says adequate.
That feels underwhelming. Who wants an adequate life? I want extraordinary returns.
The person who wants to stay rich wants adequate returns. An adequate return is one that is reasonable for the risk you are taking. It's sustainable. If you are chasing returns that are unrealistic, trying to double your money every month, you are almost certainly violating the safety of principal rule to do it.
You're taking on way too much risk.
Massive risk for that potential reward.
So these three things are a tripod. If you kick one leg out, the whole thing falls over.
Exactly. If an operation lacks these three things, if you haven't done the analysis, if your principal isn't safe, or if you're chasing a return that isn't realistic, then by Graham's definition, it is not investing. It is speculation.
It's gambling.
It is. And Graham warns extensively about speculative operations. He talks about the potential pitfalls, and he's not being dramatic.
But wait, is speculation always bad? I mean, people love to gamble. A little flutter here and there, it's fun. What if I want to put a few $100 on a meme stock?
And Graham acknowledges that. He's not a killjoy. He basically says, if you want to take a small, clearly defined amount of money you can absolutely afford to lose and keep it in a separate account, go for it. Have fun.
The mad money account.
Your mad money account. Exactly. Yep. That is entertainment. The problem, the danger zone, is when people speculate while thinking they are investing.
Ah, self-delusion. That's the real trap.
Correct. It's like walking into a casino, putting your life savings on red at the roulette table and telling yourself, I am executing sophisticated financial strategy. No, you aren't. You are gambling. And if you confuse the two, you will eventually lose your principal.
That's terrifying when you put it that way. It really highlights the psychological games we play with ourselves.
It should be. Graham wants you to avoid the behavioral finance principles that lead people astray. The fear of missing out, the excitement of a rising stock, the envy you feel when your friend makes a quick buck. Those are emotions, not analysis.
So step one is just being brutally honest with yourself, looking in the mirror and asking, am I analyzing this business or am I just hoping it goes up?
Right. And once you decide you want to be an investor, not a speculator, Graham complicates things a little bit because he says not all investors are the same. You can't just use one cookie cutter approach.
This is section 2 of our dive, the Know Thyself section. This feels like it's straight out of a philosophy text.
It practically is. In chapters 4 and 14, he categorizes intelligent investors into 2 distinct groups. And this is crucial because you have to pick a lane. You can be a defensive investor, or you can be an enterprising investor.
I love this distinction because it feels very democratic.
Yeah.
It's not about how smart you are or how much money you have. It's about effort and maybe temperament.
It is entirely about effort and attitude. How much time and energy are you willing to commit to this?
So let's start with the defensive investor. Give me the profile. Who is this person?
The defensive investor is someone who prioritizes minimizing risks above all else. Their focus is on creating a general portfolio policy.
Okay, translate that. What does that mean in plain English?
They want a strategy that runs on autopilot to some degree. Think about the person who has a demanding full-time job. Maybe they're a doctor, a teacher, an engineer. They have kids, hobbies, a social life. They do not want to spend their evenings reading 100-page annual reports or listening to earnings calls.
They want to make money with their money, but they don't want investing to be their second job.
Exactly. They want safety, they want decent, adequate returns, but they don't want the stress or the workload of active decision-making. Their goal is preservation and steady growth without constant oversight. It's a set-it-and-forget-it approach, more or less.
That sounds like most people, or at least what most people should be.
It is the right path for the vast majority of people. A defensive investor buys high-quality bonds and a diversified list of leading common stocks, or just buys low-cost index funds and holds them for a long, long time. They don't fiddle with it.
But then you have the enterprising investor.
Yes, the other path.
This sounds more dashing. Enterprising. Who is this?
The enterprising investor is willing to put in the work. And I mean work. This is the person who enjoys the hunt. According to the source Q&A, this investor looks for undervalued stocks in neglected sectors.
Neglected sectors. That doesn't sound very exciting. It sounds like the opposite of what you see in the news every day.
It usually is. While the speculators are chasing the hot AI stock or the trendy tech company, the enterprising investor is looking at the boring manufacturing company or the utility provider that everyone has forgotten about. They are looking for things that are unloved, unpopular.
Why? What's the advantage there?
Because if they are unloved, they might be cheap. And if they are cheap but financially solid, that is where the opportunity for outsized returns lies. You're trying to find value where no one else is looking.
So the enterprising investor is trying to beat the market average. They're not content with just matching it.
Yes. But Graham is very, very clear on this point. To do this, they must use specific methods that are not mainstream. They have to apply rigorous criteria regarding financial health, earnings stability, and pricing. You can't just be active. Trading a lot doesn't make you enterprising.
So just buying and selling a lot makes you a trader, not an investor.
Exactly. To be enterprising, you have to be smarter and harder working than the crowd. You have to have a justifiable reason to believe you know something the market is missing.
That's a reality check. I think a lot of us want the returns of the enterprising investor. We all want to beat the market, but we only want to put in the effort of the defensive investor.
That is a classic trap. That is the free lunch fallacy. You cannot have it both ways. If you try to be enterprising picking individual stocks without doing the rigorous work, you don't end up as a defensive investor. You end up as a speculator.
You end up as the worst of both worlds.
Absolutely. You take on all the risk of stock picking without the analytical edge that gives you a chance to succeed. You end up gambling without knowing the odds.
So Graham asks you to self-identify. Are you looking for safety and autopilot, which is the defensive path? Or are you willing to do the heavy lifting to find those diamonds in the rough, the enterprising path?
Right. And there is no shame in being defensive. In fact, Graham says for most people, it is the smarter, safer, and ultimately more profitable choice.
It's about matching your strategy to your lifestyle. Don't try to play a pro sport if you only have time for a casual pickup game once a month.
Exactly. Know your limits. Know your temperament.
Okay, so let's say we've looked in the mirror. We've chosen our path. Now we need tools. Section 3 is about the toolkit selection and diversification. How does one actually choose what to buy?
Well, whether you are defensive or enterprising, the core principle remains the same. Selections must be based on tangible value assessments.
Tangible value. That sounds like something I can touch and feel.
In a way, it is. It means looking at the objective reality of the business. The assets, the earnings, the dividends, real numbers you can find in their financial statements. This stands in direct opposition to choosing based on market trends or popular sentiment.
So, everyone loves this company is not a tangible value assessment. This stock is going up is not a tangible value assessment.
No. This company owns $500 million in factories and has $100 million in cash in the bank and no debt is a tangible value assessment. It's about facts, not feelings or stories.
Now, there's an interesting note in the source material about Chapter 2, the investor and inflation. Why does Graham include inflation in the toolkit? Usually when people talk about stock picking, they just focus on the company.
Because you have to know what your enemy is. Inflation is the great destroyer of wealth. Many people think, I'll just keep my money in cash under the mattress. That's safe. Or I'll leave it in a checking account.
No risk of the stock market crashing under my mattress.
True. But there is a 100% guarantee that the value of that money will go down over time. Inflation is the silent killer. The investor in inflation is a reminder that you invest to preserve purchasing power. Your tangible value assessment has to account for the fact that a dollar today is worth less tomorrow.
So doing nothing is actually a losing strategy.
Correct. Holding cash is a guaranteed loss in real terms over a long period. Investing is the only way to fight back against that erosion.
And then we have to look backward to look forward.
Yeah.
Chapter 3 covers a century of stock market history. The source specifically mentions looking at stock price levels in early 1972.
That is a very specific reference, and it matters a great deal.
Why 1972? What happened then that's so important?
It serves as a perfect cautionary tale about popular sentiment. In the early 70s, there was this group of stocks called the Nifty 50. They were the darlings of Wall Street. Xerox, Polaroid, IBM, blue chip, can't-miss companies. Everyone thought they could never go down.
They were great companies, so what was the problem?
The problem was the price. The valuations were sky high because everyone was so optimistic. People were paying 50, 60, 70 times earnings for these stocks. The tangible value was disconnected from the price. And then
Gravity kicked in.
the market crashed hard in 73 and 74. Many of those can't-miss stocks lost 80% or 90% of their value. It took years, sometimes decades, for investors to get their money back, even though the companies themselves were still good.
So a good company isn't always a good investment.
A good company at a bad price is a bad investment. Graham wants us to understand historical context. If you know that stock prices were crazy high in 1972 and then collapsed, you maintain perspective when you see similar things happening today. You realize that just because things are expensive now doesn't mean they will stay that way.
It prevents you from getting caught up in the "this time is different" narrative.
It is almost never different. Human nature doesn't change. Greed and fear cycle over and over again. History is our guide.
Now, within this toolkit, there is one tool that seems to be Graham's favorite for emotional comfort, especially for that defensive investor: diversification.
Yes, this is absolutely crucial. The source highlights a beautiful quote here, and it's worth hearing again. Simply by keeping your holdings permanently diversified, you will always be able to say with a quiet confidence, "This too shall pass away."
I love that phrasing, quiet confidence. It sounds so zen. It sounds like a meditation app, not a finance book.
But think about the emotional weight of that. If you own one stock, let's say you put your entire retirement into one tech company and it crashes 50%.
I'm panicking. I'm sweating. I'm checking the price every 5 minutes. I'm thinking about how many years I have to work before I can retire. My life is stressful.
Exactly. Your life is in turmoil. Your decisions will be driven by fear. But if you own 30 stocks across different industries, utilities, manufacturing, retail, tech, or if you own a broad index fund and one sector crashes,
I might be annoyed, but I'm not ruined. I can see that other parts of my portfolio are holding up.
you can shrug. You know the whole portfolio will likely recover over time. You can look at the chaos and say, "This too shall pass." It gives you the fortitude to ride out the storm.
It turns investment strategy into an emotional anchor. You're building a boat that can handle the storm rather than trying to predict when the rain will start.
That is the essence of it. Diversification isn't just a mathematical trick to optimize returns. It is a psychological tool to prevent panic. It saves you from yourself.
Speaking of preventing panic, that brings us to section 4. This is the big one. The source says this concept contains the primary principle of investing. It's from chapter 20.
This is the holy grail of Graham's philosophy. If you forget everything else we talk about today, remember this: the margin of safety.
It sounds important. Let's define it. What is the margin of safety?
Simply put, it is a cushion. It is the difference between the price you pay for an investment and its intrinsic value.
Okay, price versus value. We've touched on this, but let's make it concrete. Could you give us a real-world analogy? Something outside of finance.
Sure. Imagine you are an engineer building a bridge. You do the math, all the calculations, and you know that the heaviest truck that will ever cross this bridge weighs 10,000 pounds. When you build the bridge, do you build it to hold exactly 10,000 pounds?
No way! That's terrifying. If the driver had a heavy lunch, or if there's a strong wind, or if the steel is slightly flawed, the bridge collapses.
Exactly. So what do? You build it to hold 30,000 pounds.
Even though you only ever expect 10,000.
Right. That difference, that extra 20,000 pounds of capacity, is your margin of safety. In investing, it exists to allow for errors in judgment or unforeseen market conditions.
Because even the best analysis can be wrong, right? We aren't psychics. The future is uncertain.
We are human. We make mistakes in our calculations. Or maybe our math is right, but a pandemic hits. Or a war starts. or a new regulation destroys the industry. The margin of safety protects you when you are wrong or when the world throws a curveball.
So how does this look with a stock? Walk me through it.
If you do all your homework, your thorough analysis, and you calculate that a company is worth $50 a share based on its assets and earnings power, you don't buy it at $49.
There's no room for error.
There is no margin there. If you're slightly wrong, you lose money. You wait. You wait until Mr. Market offers it to you at $30 or $35.
So if you buy it at $30 and it turns out you were wrong and it's only worth $40?
You still made money. You're still safe. That cushion protected you from your own flawed analysis.
The source uses a practical example regarding bonds to explain this too. How does it work there?
Right. For fixed value investments like bonds, the margin of safety is determined by ensuring a company's earnings significantly exceed its interest charges.
So if I'm lending money to a company, which is what a bond is, I don't just want to know they can pay me back today when things are good.
You want to know they could pay you back even if their business drops by half? If a company owes $1 million in interest per year, you want them earning $5 million, not $1.1 million. You want a massive amount of room to spare.
This really connects back to the sleep soundly promise we made at the start. If you have a wide margin of safety, you don't have to stress about every little market wiggle. You're not on a knife's edge.
That is the synthesis. You don't need to be a prophet, you just need a cushion. It is the antidote to anxiety. If you bought that dollar bill for 50 cents, you don't care if the market thinks it's worth 40 cents tomorrow. You know the value is there, and you bought it cheap.
But here is the hard part. To buy that dollar for 50 cents, you usually have to buy when everyone else is selling. You have to buy when things look bad, when the headlines are scary, when there's blood in the streets.
And that leads us perfectly into Section 5, psychology, discipline, and the famous concept of Mr. Market.
The source talks about behavioral finance here. It's a huge field now, but Graham was way ahead of his time.
Decades ahead. He was a behavioral economist long before the term existed. He understood that the investor's worst enemy isn't the economy or the Fed or the hedge funds.
It's the person in the mirror.
It's your own emotions. We are biologically wired to follow the herd. If everyone is selling, we feel scared, physically scared, and we want to sell to relieve that pain. If everyone is buying, we feel greedy and have this intense fear of being left out. FOMO.
And Graham addresses this with his view on market efficiency.
He argues that the market is largely efficient, but not always. He doesn't believe you can outsmart it every day.
Meaning, usually the price is right or close to right, but sometimes it's way off?
Correct. The market swings, it has moods, it goes from euphoria to depression. And Graham anthropomorphizes this, he gives it a personality, and he calls it Mr. Market.
I love this character. Let's bring him to life for the listener. This is probably the most famous allegory in all of investing.
It is. Imagine you own a business, a small hardware store maybe, and you have a business partner named Mr. Market. Every single day, without fail, Mr. Market comes to your door. And every day, he offers to either buy your share of the business or sell you his share.
Okay, so he gives me a price every day, a quote.
Yes. But here's the thing about Mr. Market. He is an emotional wreck. He is manic depressive. Some days he is euphoric. He's read some good news, business is booming, and he sees only sunshine and rainbows. On those days, he offers you a ridiculously high price for your share.
I'll give you $1 million for your half of the hardware store.
Exactly. But other days, he's deeply depressed. He's heard a scary rumor. He thinks a recession is coming. The world is ending. On those days, he comes to you and offers to sell you his share for pennies on the dollar.
This store is worthless. Take my half for $5. I just want out.
Now, here's the key question. If you are a rational business owner, do you let Mr. Market's mood swings tell you what your business is actually worth?
No, of course not. I know how many hammers and nails I'm selling. I know what the rent is. I know what the business is actually worth based on its tangible value. His price is just noise.
Exactly. The intelligent investor knows that Mr. Market is there to serve you, not to guide you.
That's a powerful distinction. You don't look at the ticker price and say, Mr. Market is panicking, so I should panic. You say, Mr. Market is panicking. Is he offering me a bargain?
Precisely. The strategy is to ignore him on his euphoric days, or maybe even sell to him if his price is absurd. And on his depressed days, you check your analysis, and if he's offering you a great business for far less than it's worth, you buy from him. You take advantage of his mood swings.
You rely on your own analysis, not on future earnings projections, which are just guesses about what might happen.
They're just stories. There are a couple of key quotes from the source that I think are great rules to live by here. One is, Know what you are doing, know your business,
Do your homework.
and the other, have the courage of your knowledge and experience. That courage is critical. It is easy to say, buy low, sell high, sitting here in a studio. It is incredibly hard to actually buy when the news is terrible, your friends are selling, and your portfolio is dripping red ink.
It's hard to be the only one at the party not drinking the punch. You feel like you're missing out or that you're crazy.
It is. It's hard to stand apart. It takes genuine conviction.
But that's where patience comes in. The Q&A section of the source mentions bargain issues. This feels like the final piece of the psychological puzzle.
Patience is crucial. You cannot succumb to market fads. Fads are expensive. Value is often boring and requires waiting. Mr. Market might stay euphoric for a long, long time.
So you could be sitting on cash for months or even years, waiting for an opportunity.
Yes. And that's hard. You'll feel like you're falling behind. But the intelligent investor is playing a long game. They are happy to hold cash and wait for Mr. Market to get depressed. They are willing to look stupid in the short term to be successful in the long term.
So let's bring this all home. We've covered a lot of ground today. We've gone from definitions to psychology to toolkits. If we had to boil this down for the listener who wants to start applying this tomorrow, what are the key takeaways?
If we summarize the principles, it really comes down to 4 pillars. First, safety of principle, don't lose the money. That has to be your number 1 rule. Shift your focus from how much can I make to how do I protect what I have?
Right, defense first. Offense comes later.
Second, thorough analysis. Don't guess, don't listen to tips. If you don't understand the business, don't buy the stock. Treat it like you're buying the whole company, not just a little piece of paper.
Do the work.
Third, the margin of safety. Build that bridge strong. Always demand a discount between the price you pay and the value you get. That cushion protects you from your own mistakes and from bad luck.
And finally, the hardest one.
Independence. You must divorce yourself from the crowd. You have to think for yourself. Mr. Market, the news, social media, they are all there to provide you opportunities, not to tell you the truth.
The final lesson from the source is clear. The intelligent investor must remain independent, conduct research, and prioritize fundamental value over speculation.
It sounds so simple when you list it out like that,
Yeah.
but it is incredibly difficult to execute because it requires fighting human nature every single day.
Which brings us to our closing thought. We talked about quiet confidence. In a world that is obsessed with quick crypto gains, viral stocks, and, going to the moon, Graham offers an alternative that is, frankly, boring.
It is boring, but it is revolutionary.
It's the ability to look at a crashing market or a booming market and just take a breath and say, this too shall pass away. So here is the question for you, the listener. Do you have the courage to be boring? Because in the world of investing, boring is often the path to being rich.
And excitement is very often the path to being poor.
That's a powerful place to leave it. Thank you for diving deep with us today into The Intelligent Investor.
It was a pleasure, a timeless book.
We'll see you on the next deep dive. Stay rational out there.